Hey everyone, welcome back to lesson 4 of this little series we have going. Last time we looked at stock market indexes, what they are, why they matter, and how they help you track the overall market. In today's lesson, we're talking about two of the easiest way to actually invest in those indexes. These are ETFs and mutual funds. We're going to talk about mutual funds just a little bit. If you want a more in-depth mutual fund explanation, you could go to the other sector where we talk about specific topics, and the first video is mutual funds. In this one, we're going to talk a lot about ETFs. We will touch on mutual funds, obviously, but not as much as ETFs. It's important to understand these basics. They're simple, powerful tools that can help you build a diversified portfolio without needing to pick individual stocks. We won't talk about mutual funds like I mentioned, and yeah. So what is an ETF? Let me break it down very simply. An ETF, also known as an exchange traded fund, is a collection of assets like stocks or bonds bundled together and traded on a stock exchange, just like a regular stock. If you buy a share of an ETF, you're basically buying a tiny piece of every company or asset inside that fund. One share of the ETFs gives you exposure to the whole basket. That's why when they say ETFs are a way to invest into diversification, this is why you are buying a basket with lots of different stocks in it. So like I said, instead of buying all 500 companies in the S&P 500 individually, you could just buy one share of SPY, which is an ETF that tracks the S&P 500. And then you instantly own a little piece of all 500. So why do ETFs exist? ETFs were created to make investing easier and more accessible. Let's say, for instance, you're interested in investing in technology. Instead of researching and buying 20 different tech companies, you could buy XLK, which is a tech sector ETF. Now, with one purchase, you've got exposure to the whole tech industry. Why is XLK similar to the S&P 500, you may ask? Well, sorry, to the SPY? Well, let me just quickly show you. Here we go. So the XLK is similar to the SPX, which is the S&P 500 index. We're not, so just to remind you, this is the SPX, not the SPY. This is a stock to the ETF, not an ETF to an ETF. And the reason is because many of XLK top holdings are also major components of the S&P 500. And they carry significant weight due to how the S&P 500 is constructed. ETFs give investors a way to instantly diversify, like mentioned. You can trade entire sectors or markets with a single click, lower costs compared to actively managed funds, and you buy and sell like regular stocks during market hours. So what are mutual funds? A mutual fund is a type of an investment vehicle that pools money from many investors to buy a collection of assets, like stocks, bonds, or a mix of both. It's managed by a professional fund manager who decides what to buy and sell inside the fund based on specific strategy or goal. Think of it like a giant pot of money that thousands of people contribute to. The fund manager takes that money and builds a portfolio. Then, as an investor, you own shares in that fund, which represent your slice of everything it owns. Well, there are a couple key features. So one big main one, like I just mentioned, it's professionally managed. The fund has a team that picks the investments for you. They are priced once daily. Unlike ETFs, you can only buy or sell mutual fund shares at the end of the trading day. There's usually a minimum investment, typically requires at least $500 to $3,000 depending on the fund to start. And there are fees, usually higher than ETFs due to active management, can include expense ratios and sales load. An expense ratio is an annual percent fee, and then sales loads are one-time fees to buy or sell. The reason the fees are higher is because obviously there's someone managing and they need to be compensated in a way. An example of this is the Vanguard 500 Index Fund, VFIAX. It's a mutual fund. It tracks the S&P 500, kind of like the SPY or VOO. The expense ratio for this stock is 0.04%. The minimum investment to buy into this mutual fund is $3,000. And then it follows a passive strategy, which means it tries to mirror the performance of the S&P 500. And the price set at the end of the day based on the NAV, net asset value. Now, the strategy and net asset value is talked in the mutual fund video, so if you want to learn more about that, go to that video after you watch this one, obviously. So this is one of the most popular mutual funds in the world and a favorite for long-term retirement investors. So basically, to summarize, mutual funds is basically pooled investment managed by professionals. It's good for long-term investors who want handoffs, diversification, and they're less flexible than ETFs, but still useful, especially in retirement accounts or automatic investment plans. So mutual funds compared to ETFs. Mutual funds and ETFs are both ways to invest in a group of assets. We know this, but they work a bit differently. Mutual funds are typically bought directly from the fund provider, and you can only buy or sell them at the end of the trading day. ETFs, on the other hand, trade on the stock market, so you can buy and sell them anytime the market is open. Here's a quick breakdown. ETFs trade like stocks. You can buy them anytime during the day. Mutual funds once per day. ETFs have lower fees. Mutual funds usually have a higher minimum investment, and ETFs more tax efficient thanks to how they're structured. I suggest for beginners, ETFs offer more flexibility and lower costs. It's easy to buy and you go. Do a bit of research on what ETF, what you want to track. Easiest thing, go to SPY or VO. I like those two a lot. I also like VFE. Just go on whatever broker you have, search it up, buy in. There you go. You got a big diversification. Hold those, forget about them. Look back in 20 years, you should be up a decent amount. And then you should always buy in extra, buy more and more and more. Okay, so the anatomy of the SPY. Let me just. Sorry. Oh, okay. So the anatomy. Okay, this is what I was looking for. Okay, so. Anatomy of an index ETF. So right here we're looking at the SPX compared to the SPY, I'm pretty sure. Yeah. So the SPY tracks the S&P 500 like I mentioned, which means it holds shares of the 500 largest public companies in the US. The SPY is market cap weighted, so bigger companies like Apple and Microsoft take up more space in the fund. This is also why it's not perfectly tracked, as you can tell. It's rebalanced every few months to stay aligned with the S&P 500. Its expense ratio is just 0.09%, which means you pay $9 per year for every $10,000 you've invested. You get massive diversification and low fees, all in one ticker symbol, which is good. So we can see it's pretty much identical. The reason you could see that's not perfect is because obviously, like we say, it's weighted. So you could have more of one stock. That's why. And if a stock is that one stock you're holding, so for instance, say we have a lot more Apple and Microsoft performing very, very well. Yes, it's going to reflect the S&P 500, but it's also going to reflect a little more in the SPY, because you have more of it. But yeah. So there are different sectors in ETFs, sectors and thematic ETFs. Not all ETF tracks broad indexes like the S&P 500. Some focus on specific sectors or themes. So three we're going to talk about is the XLK, XLF, and TAN. XLK focuses on technology, XLF focuses on financial companies, and TAN is all about solar energy. These ETFs let you zoom in on one specific part of the market. Just be careful if you already own a broad ETF like the SPY and you add XLK, you might be doubling up on the same tech stocks. What is this? I don't remember. Oh, okay, here. So here right now we have the three. So we have the S&P 500 index right here. We could see that XLK is above here. Right below we have the XLF, which is financial companies, tech companies, and at the bottom here we have TAN, which is about solar energy. Now you may be wondering, right here we could see that it was outperforming, but all of a sudden, right around in 2020, around March-ish, May, we had this big drop. You may be wondering why. Well, TAN, which is the Invesco Solar ETF, is going down while the S&P 500 is going up because they're driven by very different factors. The S&P 500 is a broad market index dominated by large cap tech companies like Apple, Microsoft, and Nvidia. Therefore, you can see the tech is a little higher, that are currently benefiting from trends in AI. They got strong earnings and a general market optimism. TAN, on the other hand, is a highly concentrated sector ETF focused solely on solar and clean energy companies. These stocks tend to be much more sensitive to rising interest rates, which increases borrowing costs and reduces the appeal of long-term infrastructure projects like solar installations. Additionally, the clean energy sector depends heavily on government policies and subsidies, so any political uncertainty or stalled legislation can drag TAN down, even if the broader market is rising up. So one thing we could say is Trump loves his fossil fuels, and you can see after election it went even more down. In short, TAN is falling not because the overall market is weak, but because the solar sector is facing its own set of challenges. So you gotta do understand that when you're investing in these ETFs, they might not be following a index like as a whole. It could be only following a certain part of an index, and if that sector of the index is actually underperforming, then your ETF will go down compared to the S&P 500, because even though the S&P 500, that sector could be down, the other sectors could be performing very well, which will help reverse and still be a positive increase over time. But an ETF, if you're only focusing on just that one sector and it's performing bad, well, then your ETF will perform bad. It's pretty straightforward, to be honest. Okay, so active and smart beta ETFs. Most ETFs are passive. They just track an index, but some are actively managed. That means a human manager picks the stocks in the fund. In this example right here, we have ARKK. It's an actively managed ETF led by this woman right here, Kathy Wood. ARK, we're just going to ARK. It's called ARKK, but we're just going to call it ARK. ARK focuses on innovative and disruptive companies in areas like artificial intelligence, AI, genomics, fintech, and robotics. For instance, like think Tesla, Roku, and CRISPR's. Unlike index ETFs, which passively follow a preset list of companies, ARK's holdings change frequently based on managers' conviction and market outlook. This gives its potential to outperform during the bull runs in tech or innovation, but it also means performance can drop sharply during market pullbacks or when growth stocks fall out of favor. There are also smart beta ETFs, sometimes called strategic beta or factor ETFs. These follow a rule-based strategy instead of pure market cap weighting. For example, a smart beta ETF might focus on high dividend stocks, low volatility stocks, or companies with strong earnings growth. One might target value stocks trading below their fundamentals, while another may emphasize momentum stocks that might have been outperforming recently. These strategies aim to beat the market or manage risk more effectively than traditional index funds. However, they come with higher fees than passive ETFs, and their performance often depends on market cycles. For instance, a value-focused ETF might lag when growth stocks are in favor, and vice versa. So while active and smart beta ETFs offer more upside potential, they also require you to understand the strategy behind them. Otherwise, you might get stuck in something that doesn't match your goals or risk tolerance. So here's ARK. Pretty easy. So this is ARK. It's by ARK, but the ETF is ARK. You can see this is its 1 day, 5 day. It's not bad. But yeah, just gonna close these quickly. Okay. All right, fees. We love fees. No, we don't. So what about fees? Fees matter more than people think. I also talk about this in mutual funds, and I show an example of a 1% fee and how it could change your portfolio by 25% lower. But we're talking about ETFs. So if one ETF charges, let's say 0.03% and another charges 0.75%, the difference adds up big time over the years, especially if you're investing long term, which most people do when it comes to ETFs. Always look at the expense ratio and be cautious of leverage or specialty ETFs with hidden costs. Also check the bid-ask spread, which I remember I explained, bid minus ask spread. The gap between the buyers wants to pay and what sellers are asking. A big gap means you might overpay when buying or get less when selling. So how to choose an ETF? You want to look at these main things. You want to look at liquidity, expense ratio, holdings, AUM, tracking, and fees. And AUM stands for assets under management, obviously. But we're going to start with tracking. So does it trade a lot every day? Look for ETFs with high daily trading volumes, 1 million more plus shares per day. More volume usually means tighter bid-ask spreads and easier execution at fair prices. Another one is expense ratio. This is the annual fee that fund charges as a percentage of your investment. A lower ratio like 0.03% keeps more of your returns over time, and then higher like 0.5% or more can eat your gains. Holdings. Check which stocks or bonds the ETF owns, obviously. Check what's in that basket. Make sure it matches your goals. For example, some tech ETFs might be heavily weighted toward Apple and Microsoft, while others are more diversified. AUM, also known as assets under management. Bigger usually means more stability. A larger AUM over 1 billion is a good benchmark. It means that the ETF is widely used and less likely to shut down. It also usually means better liquidity and lower trading costs. We also have tracking. How well does it follow its index? Good ETFs closely mirror the performance of the index they track. Look for low tracking error, which means the ETF is doing job efficiently without big deviations. And deviations is just how far you are off the average. Also talked about and explained better in mutual funds. But it's the same concept. It's just one's ETF, one's a mutual fund. And then you can find all this info on any finance app or ETF screener. The last thing I do want to talk about is mistakes and action plan. So common beginner mistakes are chasing performance. Don't buy last year's best ETF hoping it repeats, because we know that just because it performed good last year doesn't mean it's going to perform this year. Ignoring fees. You do not want to ignore fees. They may seem small, but they add up over time, especially because I'm just going to be honest, you're going to hold ETFs long term. Nobody shorts them. Nobody like holds them for a short period of time. No shorts. And yeah. Overlapping ETFs, owning SPY, QQQ means sure you have two ETFs, but those two ETFs basically hold the same stocks. So like one may have more weighted to the other, but at the end of the day, it's basically the same. Okay. And then leverage inverse ETFs. Risky products not meant for long-term investing. Sometimes people invest into these ETFs that are actually not meant to be invested long-term, but they do, and it can result in a loss of money. You should stick with basics while you're learning. And then an action plan. So to buy this ETF, it's very, very simple. Go in your brokerage app. I personally use Interactive Brokers. If you want to start off with something very simple, I say go to Wealthsimple. It is the easiest thing. You quickly set up an account, put in money, and you could buy your first ETF. You could look up an ETF, let's say SPY, VTI, VFV, VOO, QQQ, all these ones. I say your first one you should ever buy. I like VOO and VFV. Those are two very good. They're by Vanguard. Pretty good. They're also down right now because of all this tariff stuff, so it's probably a good time to buy in. You could buy in at the same price that it was in November, roughly that time. It's going to go up. It will always go back up, so buy in now. You won't regret it. Compare their expense ratios and top holdings, and then obviously add one to your watch list. If you don't want to buy right now, you could just watch over it and you can see how it's performing, look at news, all that stuff. And yeah, thank you. I do want to say this is a reminder before anybody takes this the wrong way. Everything I mentioned is only for educational purposes. I'm not giving investment advice, and I'm not an advisor. So if you take investment advice, like I just said about the few ETFs, I am not giving you investment advice. These are just suggestions and things you could look at. If you are buying, please don't blame it on me if it goes down. Don't blame it on me. I told you, it's just educational. And yeah, thank you so much for watching.